Well, good. First and foremost, just some housekeeping stuff. I know as normal, there's typically about half of those coming in and listening are from our clients of ours and or work with us. The other half are brand new, might not have heard some of the subjects we're going to talk about. Really excited today to share some applicable things that you can be doing in your life, but also sharing with others as well. So, aloha, welcome. And as we get started, as far, first and foremost as well, our disclaimer at Horizon Trust Company, our focus is really on giving you the best tools in the vehicle to make sure that as you invest using your IRA, when you self-direct, you pick and choose those investments. We do not choose them on your behalf. You, as the owner of the IRA, get to choose those investments. So, at Horizon Trust, this webinar came about primarily because most people are saying, hey, I want to hear real life examples of what people are doing with their money, how it works, how do they do it with their IRAs so they can avoid paying taxes. So we're going to give you some examples. Again, you can always consult and should consult your attorneys and our CPAs for special advice. Our focus is to give you as much content and education as possible. So to get started today, and again, also in the chat, if you've got questions throughout, we're going to, towards the end, spend a good amount of time answering questions. So feel free as we're going here, we'll talk about a couple of different subjects to ask any questions you might have. At Horizon Trust, a foundational item as well, just to be clear, if you're listening to this and you have always wondered or heard of self-directing and you're on here because you want to learn about how to unlock your retirement money and use it the way you want to use it, then you're at the right place. If you're one of those individuals that have an IRA or old 401k from a previous employer, there's many people that have these old 401ks from previous employers that are just out there. You think they might be too small to do anything with. I assure you, there's almost no retirement account too small to do something creative with. And so our goal at Horizon Trust is to help you, teach you how to unlock, get access to your retirement funds, then in turn to invest in what you know, like, and trust, and what you understand. So, so that being said, today I got two special guests. Looking forward to today. Really special guest for me. One you guys might have heard of. At least you've heard of his name, his last name. My son, Carson Herlean. Welcome, Carson.
Thank you. Thanks for having me, Dad. You've had this show for weeks and you haven't brought me on. I'm kind of upset. So thanks for finally
Well,
bringing me on.
Well, if it makes you feel any better, we've had it for months and months actually, and so it took me a minute. But no, we've had it for a hot minute, and Carson, I really wanted him to be involved this way today because we are going to talk about money in particular and unlocking money. And Carson is Devin and I both have been able to see Carson in his journey. And part of why I love having Carson, not only because he's my son, is because if you're in that place where you are either very young or just starting or have a child that you want to be kind of learning about money, I think he is look, I couldn't ask for a better son, and I couldn't be more proud, but I also didn't know we'd be doing these calls with him here today. That was not my intention 4 or 5 years ago. He's taken this on himself, so I'm very proud of him. So, other guest I want to share with you today also is Devin. Devin Burr is a rock star in his own field and space as well. I remember when Carson first started getting in the space of unlocking money and understanding money and how it works. He's like, I just want to be like Devin when I grow up. And I was like, wait, you don't want to be like your dad? He's like, well, yeah, that too, but like Devin's the man. And so Devin has built a incredible business as well, teaching people the power of money and banking and taking back control. Both of these individuals do this very well. And so, welcome, Devin. Thanks for being here, man.
Thanks for having me. And yeah, I couldn't have said it better myself about Carson. Just super proud of you, dude. What you've been able to do at such a young age, 21 years old, is just insane. What you're doing, how you're helping people. I'm a firm believer, just the more people you help, the more money you make. So you're helping a lot of people and you're making money doing it. So never be ashamed of that. Just always focus on helping more people. And dude, you're gonna do some amazing things. You've got a long, long road ahead of you. Proud of you, dude.
I appreciate it, man. I've been learning from both you guys for a long time. Every time I see Devin, I see posts on social media, I'm like, man, it's so dang good. It's perfect the way he says it, the audio. I'm like, man, I just got to be like Devin, man. His social media game is so good.
I'll comment on that as we talk about money today. It's so good because it's refreshing to find people, and this is why I wanted you here today, to find people that not only are doing what they're doing, but also, they're just real. And Devin, I don't. There's no like slick sales thing. It's like this is how it works. I'm doing it with or without you. You can come along or not. And so that's one thing that I've seen you do. And Carson, you've done at our dinner table, or you leave dinner, and as you're building your business, I see you teaching people about how money works, and it's very powerful. And I've spent the last 20 years teaching people about money, but unlocking money from retirement accounts. And frankly, it's a very similar message, different vehicles, but the same kind of message. And so before we jump into that, if you don't mind, again, my goal is to kind of help and teach and educate and bring on people that are having success and share kind of where they're having success, so you too can learn from it and or apply it into your business. So yes, it's being recorded, so don't worry about that. So as we do this, would you mind just kind of giving me a little background, or giving the group here a background of who you are and kind of what you're doing in particular? And Devin, you want to go first, then Carson?
Yeah, age before beauty, right, Carson? Quite literally. I'm 39. So guys, Greg just kind of hit on it. Is when I got into this, I wasn't trying to sell anybody on how to use life insurance to become their own bank. I had just learned it myself during the pandemic. I learned it because I was stuck in my house like we all were. And there's really two things we can do with our time. We can educate ourselves, or we can entertain ourselves. And that's all you can really do with your time. And when I was locked in my house, I wanted to learn something. I wanted to become a better version of myself. So I was just consuming podcast after podcast. And I heard Chris Noggle on a podcast talking about becoming the bank. And it just made so much sense. I went down a rabbit hole, learned all I could. I got my first policy May of 2020, and I started using it with my real estate that I was doing, flips and the Burr method. So I had 4 policies by the end of that year. I wasn't selling them. I was just, this is incredible. Here's how it works. And then I got on social media and started teaching people how I did it. And it was insane, guys. I'm telling you, one video I put out, I went to bed, I got up the next morning, I had 17,000 followers from that one video. I was like, this is crazy. I should just talk about this more. So I just kept talking about infinite banking, how you can become the bank. And then everyone started asking me how to do it. So I had like 125,000 followers in like a month. And everyone's like, how can I do this? How can I do this? So I thought, yeah, just go to Chris Noggle. That's where I got my policy. Go to Chris Noggle. Go to Chris Noggle. I literally sent Chris probably 100, 200 pieces of business. And it finally hit me. I was like, this is so stupid. Why don't I just be Chris? They're learning it from me. So I got licensed, and the rest is history. I've set up close to 3,000 policies now since March of 2021. Again, never trying to sell it, just like, here's how I use it. And I'll show people on my whiteboard. I'll put videos out. Here's how I move the money from here to here. And I just explain it. And then, oh, if you want to learn more, check out my infinite banking link in my bio. People would go down a funnel. They'd get on a call with me or someone on the team. I would explain it more. Again, never selling it, just explaining how it works. And then if you really understand how it works, people just want to do it. So almost all my calls would end with, dope, Devin, how do I start? I'm glad you asked. And then I'd set them up with a policy. So it's been a fun ride, man.
So Devin, real quick, how did you meet Chris?
So yeah, I set up that first policy with him May of 2020. And then I started using it right away. So I used it to lend money to a friend of mine who bought their first rental, and they were going to get like a personal loan for like 25%. I was like, that's dumb. I'll just lend you money at 12%. They were like, oh, okay. So I borrowed money from my infinite banking policy at 5%. lent it to them at 12. So I just made a 7% spread while the money's still sitting in my policy making around 6. So I literally was making money in two places. Once I saw that, I was like, this is incredible. I took all of my capital. I started 2 more policies with Chris right away. And then by the end of the year, I started my 4th one because I was just making so much money from using that money and going to do a flip while the money's still sitting in the policy, compounding and growing. So yeah, like once I started doing the actual the concept and seeing success with it, naturally Chris was like, well, let me get you on a case study. And then that's when him and I started talking more, and I ended up getting on the team, and like I said, got licensed in March of 2021.
Thanks. That's awesome. All right, Devin. Well, Carson, tell us, give us a little of your background. I mean, you've
Well,
lived half of Devin's life, so, but
well, it's funny because we're all connected. Like we all have roots that go back to one another. I started doing all of this infinite banking stuff just like Devin was. I started learning about self-directed IRAs from you, so I went on a mission. I went on a church mission 2021. Came home and I was like, all right, I want to learn what you're doing, Dad. I want to learn what these guys are teaching about real estate, about building businesses, about being in control of your money. So where can I go? Started learning about real estate, started flipping some homes, started learning about infinite banking. I met Chris, same guy Devin knows. And I started learning the concept of infinite banking, learn how to build, real estate portfolio, and learning all these different tactics. And it's funny because, Dad, you helped Chris basically start his company 10 years ago. So, Chris was working in Wall Street and he saw a presentation done by you and you guys hit it off. That was a long time ago. Since then, he's built his empire, and now I'm with him, with Devin, and we're teaching this strategy to everyone together, and it's really cool to see. And then coming into the space, working with individuals with their financial situations, helping them understand these strategies, and then understanding your business, like you teach people how to be in control of their retirement funds. How perfect is that? There's a way to be in control of your retirement funds and be in control of your non-qualified money, be in control of your investments, your purchases through a policy. It just goes so well together. And so I've been watching all these things. I've been learning from everyone, and I feel like I'm at the point where I get it, and I want to teach this to everyone else because no one in my age understands half of these things. And so to have the knowledge I have at this age, it's an opportunity to now go teach it and keep learning while I do. So that's what I'm excited about is now being a little more on a stage and teaching those people in their 20s and 30s looking to understand how money really works and how to be in control of it. So yeah, I guess that's my thoughts for you there.
well, good. Well, thanks, Carson. So, a couple things I want to kind of dive deeper into, in particular, the fundamental part of money and self-directing, and also leveraging and borrowing on insurance policies. But first, I would say relationships. A lot of people have asked me about my children, and in general, did you set up a Roth account for your kids? Did you put in dollars away for your kids? Because you're in the retirement account business. The answer is no. I didn't. And doesn't mean that's the right model, but for my model was I wanted to provide as much education and relationships I could for Carson in my other kids. And so it's up for Carson. So when Carson said he wanted to be in real estate, Carson, and we're going to get to a lot of real estate here as well. Devin, still does real estate. Carson got involved, and I introduced him to a couple different relationships that were in real estate and also in the whole life insurance policy business. And he took it from there. And he's built his own Roth, his own accounts. And I feel like anything that is given to somebody is not appreciated, if not earned. And I've seen that in Carson's shoes. He's now earning it on his own money. He's funded his own Roth. He's more careful about his self-directed IRA account because it's his money. And so one thing I want to share again, and I'll go back to this probably a few times, is if you're listening to this call and we're talking about money in general, both IRA and non-IRA money, there's different vehicles that you can invest and put your monies into to get the best leverage and or growth. And so when talking about non-IRA money, these whole life policies are interesting. This is not, this is not a sales pitch for even self-directed IRAs or whole life. This is to give you as much content and information for you to go out and figure it out on your own. But hopefully these are some tools that you can understand. We help at Horizon Trust literally hundreds of people every single month open up or move over money from their current IRAs or their old 401ks. There's over 100 million retirement accounts in the United States. So basically a third of our US population has a retirement account that qualifies to self-direct. So I've just learned at young at my age as well, when I started a couple of years older than Carson, that if you are in a place where you are just sick of the returns or not getting the returns that you're used to or that you'd like to be getting, bet on yourself. And that's what I do. I use my retirement funds in betting on things I understand, which typically for me is real estate. And so I want to give you an example of something, and Carson, correct me if I'm wrong here, because I've shared this example last week, and Devin, I'd love to hear one of yours as well, where Carson has used both of these philosophies. And let me start with the infinite banking concept, where he's able to put non-qualified or money from his bank account into an insurance policy and then borrow, just the way Devin just said, money out of that policy, and able to put some of that money not only into an investment, but also he's able to fund and create his Roth self-directed IRA. So he could take money out, put it into a Roth, put it into an investment, pay back that loan, right? And like Devin talked about, and he can have both vehicles, because that's one of the things that I think a lot of people ask me, and also Chris Nagel when I've had him on, is like, well, which thing's better? I don't think there's a better. There's more of which can you do? Can you financially, set up a retirement account and also a whole life policy and create your own bank? And if you're able to do so, it's the right move. And when I say if you're able to do so, we're talking about $5,000 or $10,000 is all really per year into an insurance policy and or into a Roth account. You don't have to put a ton of money in to get started. I think that's one of the biggest misconceptions is they like one or both these things. They're like, well, I can only do one, and or I got to start with $100,000. That's definitely not the case. If you got $10,000 or $5,000 in your bank account and you just want to change the way you're banking, these policies work for that. If you also in that same position, you're like, hey, look, I don't have a retirement account set up. You can set up a Roth account for $5,000 and start lending. You can invest in Bitcoin. You can invest in real estate with your self-directed IRA. You can invest in loans and in businesses. Right now, if Devin's got a deal, and I know Devin's done a lot of real estate. In fact, I think that's how you and I started first talking, is I could lend my Roth IRA and a loan or partner with Devin or Carson in their real estate transactions. In fact, I think you guys have done some deals together. I can lend, well, maybe not to Carson because he's my son. There's a few rules, but I could lend to Devin. We both could lend to Devin in a real estate transaction and get a fixed interest rate back. And for me, and I think the message when talking about money, and I'll turn it over to you guys and give some feedback if what I'm probably missing a few things here, but the idea behind taking back control of your money in your IRA or non-IRA is doing just a little bit better. You're probably not used to hearing when people talk about these big investments and these badass returns. I'm not out here to say you got to double your money in year one. Obviously, we need to double it in 4, 5, 6 years. But if you're currently in the stock market and you're making 4 or 5% or negative 4 or 5%, or maybe averaging 8 if you're lucky, if you can just go from 8 to 10, that 2% per year compounded year after year is hundreds of thousands, if not millions of dollars of difference just by doing some small changes. And I think that's the powerful thing about both of these vehicles we're talking about. So anyways, Devin, do you have an example as well that maybe you can share with our listeners about how you've kind of leveraged money, like a specific deal that you've done or that you borrowed from in particular?
Yeah, I can definitely get into a lot of examples for you guys, and just I want to touch on a couple things. Like one thing Greg said, and people might not have caught this, is control. That is the biggest thing when it comes to creating wealth, is having control. The more control you have of your money, the less risk you have of losing it. So think of compare it to a car. If you're driving your car and your brakes go out, you've lost control of stopping your car. What goes as far as your risk of crashing? It goes up. right? Because you've lost control of the car. Your money is no different. If you lose control of it, you put it into a regular 401k, a regular IRA, you've got no control until you're 59 and a half, right? If you put your money in the bank now has control of lending that money out. So keeping control of your money is paramount. And that's why a self-directed is so good, because instead of it just being somewhere where you have no idea what it's going to do, no idea what it's in, you now have control. I'm going to lend it to Devin. I know Devin crushes it on his deals. He's conservative with his deals. I'm going to lend it to him. I'm going to make a steady Eddie 10%, whatever it might be on the deal. I'm going to put it into gold because I know gold's going to go up. I understand gold. I'm going to buy and sell shoes. I understand shoes. Now you understand it. You can control and mitigate your risk. So I really want you guys to remember that, because that is the main thing with infinite banking. You have total control of your money. You put it into a place that's guaranteed to compound and grow. It'll never stop growing contractually, guaranteed, tax-free. So if it's going to keep growing, guess what you can do? You can always leverage more of it. Think of a house. If a house is guaranteed to go up in value, you can keep taking more of the equity out to use. And it's not your money, it's the bank's money. Same thing with a policy. You put your money in a policy, it's guaranteed to compound and grow. You can now borrow against it and use the insurance company's money. They're just letting you use your future death benefit while you're alive. So if you never pay it back, which you never have to, again, total control, they just lower it when you pass away because they know you're gonna die. It's guaranteed. They just don't know when. So if you don't pay back some of your policy loans, they just won't pay the full death amount to your family because you use some of it while you're alive. You have total control. So that is huge, guys. That's huge to have control. And then another thing I want to touch on real quick is how money works, guys, is just really understanding the different kinds of money there is. Think about this. If I pay 6% interest on a car loan, but I earn, let's say, 4% interest in a bank, does it make sense to take that interest out of the bank that's earning me 4% and buy a car cash so that I don't have to pay 6% interest on a car loan? Our brains think, yeah, that makes sense. You're saving 2%, right? But if you do the math, you will earn more on that same amount of money compounding in a bank account because it's compounding. Most people just don't understand the difference between compound interest and simple interest. Simple interest means the balance is always going down. So you're always paying a smaller amount of interest. Compound interest, the balance is always going up. So you're always earning more interest. Another thing is amortization. Think about your mortgage. For instance, Greg, do you have a mortgage on that house you're in, the beautiful house you're sitting in?
I do.
What's the interest rate?
It is 5.5%.
Don't ask him the amount his payment is, though.
So 5.5%. Would it make sense for you to have a HELOC on that house at 9% instead of a 5.5%, or let's even say a HELOC at 15%? Would it make sense to have a HELOC on that instead of your 5.5% fixed mortgage? Would that make sense?
No.
See, and you understand money, and you even say that wouldn't make sense. Guys,
explain it.
This is my point. I'll use my mortgage, for instance. So my mortgage is it's a 2.875, and I'm about to actually pay it off with a 9% HELOC. Most people say, like, that's so stupid, Devin. Why would you do that?
Right.
But think about this.
Why would you do that?
2.875% interest. The mortgage when we took it out, I think it was $630,000 was the loan amount. A 30-year mortgage, that's $2,613 a month. And let's look at the amortization table. And I'll show you guys this so you can tell I'm not BSing. Total interest over 30 years, $310,976. Let's see if you can see, guys can see that.
Yeah,
right?
Total interest, 310,000.
Yep.
So that's on a $630,000 mortgage. I don't have a 2.875. I have a 50% interest rate because it's amortized over 30 years. It's weighted up front. How is the payment the exact same day one as it is 30 years from now? It's amortized. However, if I have that same balance on a HELOC is true simple interest. This is, again, just understanding money and how the different interests that we have out there. HELOC is true simple interest. So the payment, as I make a payment, the interest and the payment go down every single month. And here's the thing. If I make a payment on my house at 2.875, the money is trapped in the 2x4s. I cannot use the equity unless I refinance or take out an equity line. But if it's all in an equity line, when I make a payment, I instantly can use that money again if I need it. So guys, it's just understanding these different things. And we've been taught to basically make the banking system run. We've been taught a 2.875, go get that. Even if you're...
So we make decisions based upon a number, but not really how money works. Because it's like the 15 and 5% rate. Yep.
Yeah, because it's not about the rate of interest, it's the volume of the interest.
Over time, yeah. Actually, every month, right? I mean, So there's a lot of good questions. We're going to come to them, so don't worry. Keep peppering the questions. We'll come back to all those towards the end. So I appreciate that. Carson, well, actually, I want to give one more example. For those of you listening, about you mentioned the shoe example. I can buy these shoes in the shoe business. That's near and dear and heart to a lot of individuals that are into Jordans right now, especially, right? I don't have the Rolodex of shoes like I think my boys do. But that being said, I want to share an example. A lot of people, if you're listening to this and you have a self-directed IRA account and you're looking to invest in something in an alternative business or space, your IRA can fund an LLC and it can own the LLC. And that LLC's business could be in the pure sole purpose of buying and selling shoes. An IRA can buy and flip shoes. And so all that money would go back into your LLC that's owned by your IRA and go back into your IRA and not pay taxes ever, potentially, if it's a Roth. And so different type of money that we're talking about here, Devin, go back, because I think your point is very well taken, that the first glimpse is, why would I ever pay this much over a 5%? Well, understanding simple and compound is great. Carson, there's something you wanted to share as well with that after Devin was sharing his example?
Well, I mean, you were mainly asking to, examples of how we're investing through these different places, through IRAs, through policies, anywhere. And I think you're also getting to the point of wanting to ask about real estate and how, when it comes to real estate, or with real estate in general, investing within the retirement space or non-retirement space. And so you wanted to hear examples about those as well, correct?
Yeah, I like to hear. I went off on a tangent.
No, you were good. No, that's
you're good.
We're going to come back to it. But Carson, why don't you share an example? Because I think a lot of people are wondering, what's this 21-year-old going to teach us about examples he's doing? Share an example you're doing, not anything that Devin and I are doing.
Well, and that's where the question was coming from. So Devin and I have actually partnered on a real estate deal recently, and I can explain that one. So we're buying an apartment complex out in Birmingham, Alabama, which is, neither of us live there, but we have guys we know and trust that were down there working on these projects for us. And I believe, Devin, correct me if I'm wrong, but you invested through a policy, right?
Yep.
All right. So through your policy, we, as the owners of the deal, we brought in other people's money to help us purchase it and hard money lenders. And we're going to get this deal done where we're going to do the Burr method, as you talked about, Devin. We're going to purchase it. We're going to rehab it. We're going to refinance, get all our money back out, pay back Devin with interest, cash out some extra. And then afterwards, we'll put tenants in all the units, which will pay the payment of the mortgage for us, plus all our expenses, and it'll cash flow. So now we're going to get however much in equity it was, pay back everyone's all their funds, and have cash flow on the property. And Dad, you and I were talking about this morning on our podcast for Generational Gains, talking about taxes and how that comes into play when you're buying real estate. And so for this deal specifically, we're going to do a bonus depreciation, a cost segregation study, where I think the property we purchased it for, I think $400,000. There was $500,000 of renovations, and it's going to be worth about $2 million afterwards. So when we now have a property at $2 million as a valuation this upcoming year, and we do a cost segregation study where we're going to be able to write off probably 50% of the value of that, depending on the situation. That's going to be a lot of tax write-offs as well that we're going to get with this property. So now we're going to get a property that has no loan on it except the mortgage, all investors paid back. We're going to get cash flow and tax write-offs on the project. And so talking about different ways to control your money, real estate is a huge one, because look at all those things you get when you're investing in real estate. You don't get that investing in a stock account or investing in Bitcoin. You just get the appreciation and that's it. But by running these funds through these different places, a Roth IRA, we're going to get it all tax-free, through a policy where you're also going to grow, running it into real estate. These things are what the wealthy and what the rich people do. This is how they compound their wealth. And that's what I've been learning. And that's why we're trying to build and continue to do that.
No, that's really good. That's great examples. Let me before Devin, real quick, just let everybody know where we're at right now. In general, is there's a lot of different tangents we can go with, and we're gonna go deeper into some of these examples. So that being said, I want to bring it back a step. If you're listening to this and you're like, hey, look, I just want to understand the first step. Like I can't find a deal in Birmingham. I can't, this is not my game. I want, I'm retired or I have a full-time job. What kind of accounts are there for me? You're going to see throughout here, Alex, my team's going to put in the chat there a link. You can schedule an appointment where we can actually talk to you about your particular retirement account. And so if you want to understand, like, okay, what kind of retirement account should I invest? Should I use for my vehicle? Should I open up a Roth? Should I convert into a Roth? It can be daunting. Frankly, it could get confusing. And I think, I know that's why I started this company 14 years ago, because most of the people I introduced to self-directing got confused. They go to people's websites and they're like, okay, this sounds incredible, but where do I start? How do I even fill out the documentation to roll my money over and get started? First and foremost, we'll help you do that. We'll help you get your account set up, figure out which account is right for you, and we'll slow it down, get you, and then you can do a little bit of education. We actually have a cool investment corner where you can learn about different alternative assets, from Bitcoins to businesses to oil and gas to real estate. You can do your own due diligence and then tell us where you want to put a portion of or all of your funds. And so it is a simple process. And I would say, it might not sound simple, but truly it's simple, because you should find the thing that's comfortable to you. The biggest thing that I learned over the 20 some years now I've been doing this is investing in what you know and understand and who you know. And so for me, I don't really enjoy finding assets in Birmingham, Alabama. I don't want to fix them up. I don't want to be involved in the day-to-day. I like lending. And I know that leaves the upside to potential people like Devin and Carson, where they can either flip and make the upside, but getting the consistent returns inside of my retirement account and not having to deal with the day-to-day and getting passive returns is solid for IRA or non-IRA money. And there's tax advantages for those that invest outside of their IRA. That would, when Carson mentioned cost seg, I can't believe that's impressive that you mentioned that. I know we did. I guess we did talk about it. So these are the kind of conversations that not all my kids want to have, Devin. You're like, hey, how do you get your kids all to talk like this? Not quite that easy. He wasn't talking like this like 4 years ago, so don't worry. That being the case, there are some tax advantages you can do outside of your IRA, which is very powerful. And then obviously, anytime you're doing something inside your self-directed IRA, it's hopefully going to be not only tax deferred, but come out tax free later on. So that being said, Devin, I think, were you going to share something? I think after Carson on an example. Or did I miss that? I'm sorry. I thought you said you were going to say something.
No, I can definitely share an example. Like, so guys, I use policies for everything. You name it, I use a policy to do it, because a policy is just leverage. Like, think about the great thing about real estate is you can use leverage. You can use other people's money. That's all a policy is. You're using the insurance company's money, and you're just using your money as collateral. So your money is compounding and growing. You're basically saving it. It's in a savings vehicle, guaranteed to grow. It's protected against lawsuits and judgments, and you can just borrow against it. So you can get leverage. I use it to buy my watches. So I buy all my watches with policies, and I pay myself back as if I'm paying the bank. I buy all my cars. I've done my daughter's braces. I do all my real estate deals. I can share a deal where I actually made close to an 18,000% cash on cash return.
Wow.
You heard that correctly. 18,000%. That means when I put in $1, I get back an 18,000% return. Crazy, right? So basically the way it works, I've got a slide if it helps everybody, but they're pretty easy numbers. It's the cost of the house was 725 grand. Renovating it and getting furniture because it was going to be an Airbnb was 60 grand. So altogether, I was going to have to spend 785. Most people would think of that and think, how the hell am I going to do that? I had 785 grand. I could have just used all my money, but then my cash on cash return dwindles. I can only maybe do 1 or 2, 3 deals at a time if I do that.
Mm-hmm.
So I borrow other people's money. This is what real estate investors understand, is using other people's money. So what I did is I borrowed 725 grand from a hard money lender at 12%. And I knew that this deal was going to take max 4 months. It was an easy renovation. It was some paint, some new fixtures, buying the furniture, setting it up. It was going to be easy. So 4 months at 12% comes out to about $29,000 that I would have to pay that lender for borrowing their 725 grand. Okay. I borrowed 60 grand from a private investor. So that's just anyone like you and me lending money. Hard money is like a company. Private is just a person. So I borrowed 60 at also 12%. Again, 4 months, that comes out to $2,400 that I was going to have to pay that lender. So you guys do the math. If I stop there, that means my money is $31,400 to go do this deal instead of 785. So my cash on cash return would go up because I'm using less of my money. But I didn't stop there. I basically leveraged more money by borrowing from my policy. So I borrowed $31,400 from my policy. That $31,400 again is not my money's not being used. It's just collateral. I'm borrowing for my future death benefit. So my $31,400 that I put into my policy as premiums is continuing to grow about 6% when you add dividends. So I take the insurance company's money, $31,400, and I use that to pay the other investors, right? The 29,000 and the 2,400. So now the only money I have in the deal is the interest the insurance company charges me to borrow $31,400. And that's at 5%. That comes out to over 4 months, $523.33. So for me to go do this deal, money that I have, my dollars in the deal is $523. I could have spent $785,000. I'm spending $523. That's the
And
power of leverage.
So, and what kind of profit, what's the exit going to be when you flip it in 4 months?
So great question. So this was an Airbnb. So this was last year, $91,129 in profit, cash flow from the property. And then remember, my 31,400 is still growing in my policy. So over that 4 month period, it gained about $628. So altogether, I have a total profit of around $92,000, and I only spent $523. So I turned 523 into 92,000. That's the power of infinite banking. It's just using more leverage, and you're using something that's guaranteed to keep growing. So if I use that money and I lose it, that will suck, but it's still going to keep growing in the policy. I'll never lose its ability to grow in the policy on a guaranteed basis, tax-free.
Love it. Love it. Now, and I'm going to relate that as well. If you're listening to this and you want to do the same thing, but don't have enough in your policy or don't have a policy, because a lot of our listeners have a retirement account, you can do exactly what he just said. Now, it might not be, 18, what was the 18,000,
1800,
1800% rate of return. What
Oh,
you could do.
don't sell me short, Carson. It was 17,533% cash on cash return.
So that same example, you could, if you're listening to this right now and you have an IRA or a self-directed IRA or a Roth, that same example, the Roth could put up the $30,000 or $31,000, and all of those proceeds, the $91,000. Now, it's not as good a return, but I'd say a 300% rate of return on 31,000, not so bad. And so I've got a lot of people that when they talk about different deals and self-directing, they keep their sweetheart deals for their self-directed account. Why? Because they don't want to pay the taxes and they want to keep compounding. So that same example applies to both scenarios. For those of you listening that have a policy and want to leverage it and do it just how Devin said, absolutely. For those of you who, in fact, you could do 2 homes. One home you could have as your Roth, as the owner of it, your self-directed Roth. One could be outside of your Roth and do it the way he said with his policy. So both apply. And again, how we started this is really the most important part, which is controlling your money, understanding where it goes, you making those decisions. So that being said, there's too many questions. So I want to really start jumping into questions because there's some great ones I know that have been coming through. And also we're not, if we can't get to all the questions, Alex has got on here a link. If you're here and you're listening and you want to know how your IRA can potentially be self-directed and use it for properties or different asset classes or businesses, set an appointment. There's no big sales pitch. We want to help you and teach you how your account works. If you're on this call and you're like, hey, look, I'd love to hear from Carson and Devin more, and I would love to, look at doing a policy for myself, set an appointment. All you gotta do is go to our link, set an appointment. And in that appointment, when you talk to our team, you say, hey, look, I'd like to get with Carson and or Devin or both of them. They'll help you with your policies. Not a problem. So we'll give you the tools. We'll give you the information and the people and the network for you to go out and make your own decisions. But I would say if you're not doing both of these things, there's a good chance that you're missing out on a good opportunity for compound and growth and really just taking advantage of what's out there. And I think just it's a lack of education. It took me a long time. I had these policies years before Carson even was doing them. And he had to come to the dinner table and remind me of why I had these policies. Like, well, Dad, don't you have this policy? I'm like, well, yeah. He's like, well, do you ever take money out? I'm like, no, I don't take money. He's like, well, that kind of defeats the purpose. And so, like, there's people and places and processes that we can help you with to kind of guide you along here. If this was a lot of information, you're welcome. And I'm sorry at the same time, we can help answer questions. But again, the links here throughout here, you can please set an appointment. We'll get you connected here with Carson or our team or Devin, et cetera, and we'll help you out. So why don't you start here with some questions. Claudia, I got Claudia here on my team. Claudia oversees all new business, all new relationships. If you're a client of ours, there's a good chance that you've spoken to Claudia or someone on her team. She is a rock star and make sure that everyone gets their answers to their questions. So Claudia, I know there's a lot of questions, so I'll let you kind of tackle some questions and go ahead. We'll just field them as they come.
Yeah, absolutely. I have taken notes. So let's go ahead and start with a couple here. So Joe is asking, isn't it better to convert your traditional IRA to Roth and pay Uncle Sam now and save you and grow your Roth tax-free? How does that work?
Most likely the answer is yes. If you plan on really making money in your retirement account for more than the next 4, 5, 6, 7 years, you should convert it to a Roth. The bigger question lies on when should you convert it? And that comes into play based upon your personal financial situation. Your CPA might say, hey, I don't know if you said it was John or Joe that asked that question,
Joe.
but Joe, if your CPA is like, hey, look, this is a good year for you to convert because you've got some depreciation or some losses that you can offset those gains, this could be the perfect year to do it. I have a lot of people that will convert their retirement accounts to a Roth over time. They might have a $300,000 IRA and they'll convert $100,000 to a Roth this year because they only have so much in write-offs, and next year do more. So again, get with us. We'll help answer and find out what's the right time for you, and you can talk to your CPA as well. Go ahead, Claudia.
Perfect. I have seen Senia saying, do I need to create an LLC first before I begin my journey on being a private money lender with my IRA? How does that work?
You don't necessarily have to have an LLC. There's just more flexibility that comes with it. If you think you're only going to do one investment with your IRA into a deal, you might not need the LLC. But if that one investment is a deal like Devin's talking about, where your IRA is going to be purchasing and rehabbing a deal and putting some money into it, it might be better to put your IRA into the LLC, a specialized LLC that we can help you create. And then that LLC is like a checkbook for you. It's called a checkbook LLC, where you can write checks to vendors and buy the furniture that Devin's talking about all out of that LLC, rather than contacting us every time saying, hey, at Horizon Trust, please send $2,000 for this bill for this, expense on this asset. Either one works. The LLC typically is better for more transactions that are happening using your IRA.
Yes. And then to add to that, can you set up a trust to protect all of it, like a Rockefeller trust?
You can always create a trust, and there's a lot of value to having a trust. I recommend a trust. Again, that's something that when you set an appointment with us, we'll ask some more questions to find out what kind of trust and where you live and what kind of assets you currently have. But a trust is always recommended if you've got any kind of assets and children. So.
Absolutely. Karina is asking, do you have any recommendations for best HELOC companies? That's probably for Devin or Carson, or I mean, any of you guys have.
So I actually, I know Thomas, and I have his information. I'm actually going to send him the HELOC bank that we work with. But yes, there's a bank that we work with called First Savings Bank. They do this type of product, and they can help you get a fixed or adjustable line of credit. That's a competitive rate, and they know exactly what this idea is of kind of the velocity of the money. They know what that is, so they know what we want with it. So I can definitely connect you with them.
And they're not 15%. The good news, if it was 15%, it would still pencil, right, Devin?
Don't make sense.
Still pencils.
Because it's only 15% if you pay it off over the entire timeline. If you pay it off quicker, the effective interest rate is much lower than 15%.
Yeah,
that's good. Good reminder.
I have John here that says, how exactly do I make a constant setting return if you invest from an SDIRA into real estate?
Being a private lender, I would say.
Yeah. A lender's a great way of doing it. I prefer lending, getting a consistent quarterly, monthly, or annual fee or interest rate paid to my IRA. And then look, once you're 59 and a half, if you want to then have that interest payment come to your account and paid out to yourself, a lot of our clients will live off the interest, right? So the whole idea is building that your retirement account so it becomes this nest egg that you can then live off the interest being distributed to you after you're 59 and a half.
Well, I've got a little ninja move for you guys to play off that, because this is what I do as a private lender. So I always borrow money from my policy to lend. So again, when you use money in a policy, you're not interrupting the guaranteed compound growth. So I'm compounding in my policy guaranteed, and then I'm lending it to someone that's giving me 15% interest. As they give me that interest back, I let it build up for 3 months and I lend it back to them. So now I'm getting compound interest with that lender, or I'm sorry, with that investor as a lender. And I'm also getting compound interest in the policy. I'm making compound interest twice. And Einstein said the eighth wonder of the world is compound interest. So I'm doing it twice. It's crazy what you start learning and what you can start doing, even on a smaller scale. I do it on a big scale, but if you do it on a smaller scale, you have to start somewhere. In compound interest, it takes two things: time and consistency. The more consistent you are with it and the more time you give it, the bigger it becomes, which is why I'm so freaking jazzed that Carson is doing this at 21. I'm telling you guys, if I was doing this at 21, I'd probably be on a yacht right now. This would be on a yacht. You'd see like the water in the background, the sunset would be going down. It'd be incredible. So incredible.
It's all right. You'll do it at 51. It's okay.
There we go.
Yeah.
David here is asking, if we open a Roth IRA, how quickly can it be invested?
Once the funds arrive, once you give us the correct documentation, within a couple days. It's typically 1 to 2 days. So just get it set up. And remember, a lot of you that are listening, probably half of you that are listening, if you don't have a self-directed IRA account, you have an old 401k from a previous employer, or your spouse does. So those are available too. But if none of you do, which is fine, which is where I started, that's fine. You can open up a Roth with $7,000. That's the max, and we can get you started.
Perfect. John is asking, how big of a policy do I need to buy a flip if the house was 500,000?
That's a tough
Depending
one
on the
to
structure
answer.
of the deal. Yeah. If you're using other people's money, none technically, but if you're using all your own funds, then it would depend.
It depends. I think. Correct me if I'm wrong, guys, but that there's every policy comes with its own set of variables, and so I'll give you an example. If Carson right now and I, who I'm 45 and he's 21, and so if we both put $500,000 into a policy today, most likely, guys, again, correct me if I'm wrong, because you're the professionals. Most likely of that $500,000, I'll be able to pull out 440 to 460,000, and Carson be able to pull out like $490,000. Now it's all still in the account, but and this is a ballpark again, based upon some ages there. So when you have these policies, it does have something to do with your health and age, et cetera. So everyone does not qualify. If you're not healthy, it's tougher to get these policies. The policy is kind of the vehicle that allows you to create the bank. But I'm now in a territory that I'm trying to explain, and I shouldn't be. Devin, this is more. Carson, this is more for you.
You're kind of on point with it. Really, when it comes to age, guys, the only difference for the most part is just the death benefit. Because the younger you are, the longer the money has to grow. Think about when you're putting money into a policy, all it's doing is it's slowly growing into the death benefit over time. So if you start a policy at 50 or a policy at 20, the 20-year-old has longer for that money to grow. If they're putting in the same exact dollar amounts, the death benefit naturally is going to be bigger in the younger person's policy than in the older person's. The liquidity is about the same. Yeah. So nothing really changes there. The way we structure them is we just figure out how much can you put in, and we build it to that where you can put it up to that amount without it becoming taxable. Don't put in more, because then it becomes taxable. You can put up to that amount or anything below it. So try to do the max every single year, because then you're getting the max amount of money compounding, the max amount of money growing, the max amount of cash value. But if you can't, put in less and then catch it up later. So again, control. That's what it's all about, is having control of your money.
That's good. And look,
so to answer his question,
yeah, go for it. Go ahead, Carson. Well, I was just going to say, if you're looking for a $500,000 asset and you only have $250,000, you can still fund a policy. Use those funds to put down the first 50%, leverage and borrow the other 50%. That's not a problem. If you're wanting to do it all with the policy, then you got to put up at least $500,000 into a policy before you take it out. So it really depends upon how much you have.
Which I would say is not the way to do it. Again, it's all about leverage, guys. Don't use all of your money. Do what I did: borrow from hard money lenders, private money lenders, and then use your policy to pay them interest. Because then all you're doing is you're using less of your own money. You just have to pay the insurance company. And here's the crazy part, actually. You don't even have to pay the insurance company. You should, but they'll never tell you have to make a payment. You should just keep putting premiums in. They charge an interest rate, 5%. You should pay it because it helps them be more profitable, and they're mutual companies. So as they're profitable, you get a dividend. So you should pay it. But if you don't, remember, they know you're going to die. So if you don't pay it, they'll just deduct it from your death benefit. Again, total control. So if you pay it, the only money out of your pocket, your dollars, is a much smaller amount than if you go do the whole deal with your policy.
That's good. That's good. Thank you. Claudia, what else you got?
So we have Laura that's asking, do you have a property replacing if we're going to get some looking for deals to invest in?
I could barely hear you. Could you repeat that?
Same.
Oh, sorry. They're looking for a forum for investment deals.
Yeah. So look, when it comes to investment deals, the recommendations I give, first, most likely your community, meaning your social community, your industry you might already be in. That's where I would start. You probably know some successful people. But if you don't, I know once you become a client of ours at Horizon Trust Company, we also have something called the Investment Corner, This is we don't get paid for any decisions you make on there, but these are places and listings and postings of opportunities and success people have had with other companies. And so you're able to go there, log on, and you can see, from Bitcoin to real estate to oil and gas and real estate, precious metals, etc. You can go on there and learn a lot about alternative assets. I also know that Devin and Carson, you guys work with Chris Nagel. They've got, I think, the Private Money Club is something very similar. So there's so many places and circles and influences. And so I would just say, do your due diligence. Just be careful. Make sure you know who you're investing with. It is still your retirement money, so you want to be careful about it. But invest in people and/or asset classes that you know and understand. All right. Well, I'm trying to be respectful on the hour here with everybody. There's lots of questions as well that we have not answered. Alex, you can put our link up there again. If you want to schedule an appointment, ask more questions. I want to make sure that we can answer any questions you got on, even if it's the whole infinite banking concept. Message us. Let us know you want to know more. Have any questions you've got? We'll get back to all of them within 24 hours. If you're listening to this again and you have an IRA or want to open up a self-directed IRA, again, let us know, reach out to us. We'll answer all your questions on it. Really appreciate both my guests today, Devin and Carson. Thanks for being on today. I think we could have gone for like 2 more hours, so I appreciate the time. Respect all of you as well for being on here, and have a great rest of your week.
That was an hour already? Damn. All right.
Hour, quick.
All right, guys.
Thanks, guys. Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.